Good morning. Welcome to our seminar today on examining the Social Security Windfall Elimination Provision and the Government Pension Offset. My name is Jerry Hafer. I'm with the AMAC Foundation. And to begin, I'd like to briefly explain for those who may be unfamiliar with the AMAC organization, who we are and what we're about. AMAC is the Association of Mature American Citizens, and we're a senior advocacy membership organization dedicated to serving the needs of our more than 2 million members with a slate of benefits and, most importantly, with representation of their interests in Washington and across the United States. You can learn more about AMAC and its affiliated advocacy organization, AMAC Action, on the web at amac.us and amacaction.org. Today's seminar is brought to you by the AMAC Foundation. AMAC Foundation is AMAC's nonprofit public benefit corporation. The AMAC Foundation is a registered 501c3 organization with a clear mission of supporting and educating America's seniors. And we do that a number of different ways, including public podcasts and seminars like the one we're presenting today, a robust web presence with multiple websites like the amacfoundation.org, the Social Security Report.org, and MedicareReport.org. Those latter two websites are topical websites that are updated 5 days a week and bring you breaking information and background information about those two critical senior related programs. Our most prominent program in the foundation is our Social Security Advisory Service. That's a service that's offered free to the public that has served more than 33,000 folks needing guidance in making the critical decisions facing them as they enroll in Social Security. Our staff of trained and certified advisors provides counseling service on demand and has accumulated a wealth of knowledge needed to provide assistance to people frustrated with Social Security's rules, regulations, and complexities. Today, you'll be hearing from two of our advisors on the topic of Social Security's Windfall Elimination Provision, WEP, and the Government Pension Offset, GPO. And we're intended to provide background on how these regulations work and why they work that way. So, beginning with Russ Glure. Russ Glure is the former executive director of IBM Global Services Worldwide Quality Assurance Program. He's the author of numerous Social Security publications on the Foundation's behalf. He's also nationally and internationally famous as Rusty in the Ask Rusty series. That's the series that we weekly provide a question, actually a question that we've received in the advisory service and a detailed answer of all the ramifications of that question. That weekly question and answer Ask Rusty series is published to tens of thousands of media outlets across the country. And as I said earlier, my name is Jerry Hafer. I'm a former IT director for a major Northeast utility network. I've been affiliated with AMAC now for about a dozen years, and I'm also the former executive director of the AMAC Foundation. So Russ and I will be talking to you about WEP and GPO and a lot of the background information on how these provisions came to be and the way that they work. So getting into the detail a little bit, why are we talking about WEP and GPO? Well, WEP and GPO are again drawing attention in the 118th Congress. More than a dozen reform bills have surfaced in the prior three congressional sessions. None of those have made it past committee assignment. They all have carried similar titles like the Equal Treatment of Public Servants Act, Public Servants Protection and Fairness Act, Social Security Equity Act. So they're all addressing the issues behind WEP and GPO and advocating for either reform or repeal of those two provisions. Currently, in the 118th Congress session, H.R. 82 and S. 597 are being advanced. The House bill, Social Security Fairness Act of 2023, was introduced last January. The Social Security Fairness Act, the Senate bill, was introduced last March. Neither of those have had any further action beyond being read and referred to committee. But they are getting a lot of press these days as organizations advocating the repeal of WEP and GPO become more demonstrative in their interest in repealing these acts. So a little bit of history. We want to provide you some background on where these provisions came from before we get into how they work and why they work that way. So, under Section 218 of the Social Security Act, government entities are given the opportunity to exempt certain positions from Social Security participation. This means that exempted employees do not pay Social Security payroll tax, FICA tax as it's known, on earnings from that work. And their employers, the governments, do not match the FICA contribution like employees in Social Security covered jobs are required to do. Exempted employees earn a pension via a qualified government pension plan, and that's a plan that has been designed to compensate for the loss of corresponding Social Security benefits at retirement. One of the complaints we hear most often at our advisory service is that the eventual reduction in benefits resulting from application of the WEP and GPO formulas is unexpected, even though affected employees exempted from Social Security participation are advised of the consequences of not participating in Social Security. They're also advised that only wages earned in employment covered by Social Security can earn the exempted employee Social Security benefits. They're also supposed to be advised that Social Security spousal and survivor benefits may likewise be affected. We're going to get into the surprise element a little bit later and what state agencies and government agencies are supposed to do compared to what they actually do. So we're going to discuss that later. WEP comes into the picture because many exempted employees elect to also work in jobs covered by Social Security. And as noted, wages earned in employment covered by Social Security can earn the exempted employee Social Security benefits via the wages on which they were assessed payroll tax, the FICA tax. For the most part, Social Security covered employment tends to be the less significant portion of the total wages for those folks having two types of earnings in their history. That tends to create somewhat of an imbalance between covered and non-covered earnings. We're going to explore that a little bit later when we look at some specific benefit calculation examples. In general, and as we'll also discuss in the detail sections of the webinar, working in both covered and non-covered employment is what created the need for provisions, WEP and GPO, that we're going to discuss. So WEP and GPO, who's affected? WEP applies to most people who receive both a pension from non-covered work, and that's work on which payroll tax has not been assessed, and Social Security benefits based on fewer than 30 years of substantial earnings in covered employment or self-employment. And that includes certain foreign pensions. We're going to get into the 30-year parameter a little bit later, but for now, generally speaking, WEP and GPU primarily affect state and local government workers whose employers have opted out of the Social Security program. It also affects federal employees hired before January 1st, 1984, who are covered by the Civil Service Retirement System, CSRS, and also employees of nonprofit organizations prior to January 1st, 1984. So to summarize, WEP affects Social Security benefits for anyone who has a non-covered pension, including Social Security beneficiaries with a foreign pension, older federal retirees, and anyone else with a pension earned without contributing to Social Security. GPO, on the other hand, affects spousal benefits rather than the worker's Social Security retirement benefits. The effect of GPO is to reduce the Social Security spouses or surviving spouses benefits for those who also receive a pension based on federal, state, or local government employment not covered by Social Security, meaning that it is not based on wages taxed by Social Security. Specifically, GPO applies to spouses who qualify for Social Security spousal benefits on their spouse's work record in covered employment, plus their own Social Security retirement or disability benefits based on their own work record in government employment not covered by Social Security. This is where dual entitlement, the dual entitlement issue of Social Security comes into play, and we're going to be exploring that a little bit later too. So who's affected? As the chart shows, of the total 66 million Social Security beneficiaries today, very small portions are affected by GPO and WEP. About 3% are affected by WEP, and about 1% are affected by GPO. So although the portion is relatively small, statistically, when you look at the graph, it's relatively small. The individual impact, though, can be fairly significant, as you'll see in some of the examples we're going to discuss. Our advisory service has responded to many requests, thousands actually, for help when dealing with the WEP and GPO question. And we found that it's beneficial to first ensure that the process for determining Social Security monthly benefits is clearly understood. We consider that a basic starting point. You really have to understand the formula for calculating benefits. So let's look quickly at the standard formula. It begins with first determining the average Social Security covered earnings over the course of a worker's career and restating those earnings in current dollars. That's step one, and it results in something called average index monthly earnings, or in Social Security language, that would be referred to as AIME, AIME, average index monthly earnings. This is the monthly average of the highest 35 years of index earnings on which FICA tax has been paid. Index simply means that the worker's earnings have been historically adjusted to account for inflation that occurred during the 35-year career. Once AIME is determined, the second step is to apply a mathematical formula to determine the worker's primary insurance amount. That's called PIA, which is the basic benefit the worker is eligible for at full retirement. So those are the two key acronyms to keep in mind as we talk about the formula, AIM and PIA. PIA, once it's determined, allows for calculation of the income replacement rate, and that's a key component of understanding WEP. The income replacement rate is the amount of the Social Security benefit that will replace the worker's average pre-retirement earnings. The income replacement rate basically reflects the Social Security premise of progressive design, a design that calls for lower wage earners' benefits to be higher than those with higher earnings. I think this will become clear as we look at some actual examples. So I'd like to begin by looking at some of the way the math works out. Step two in the process after AIM is calculated is, as I said, is to determine PIA. And PIA basically takes the AIM amount, the average index monthly earnings, the highest 35 years of average index monthly earnings, and subjects them to a three-part formula, the first part of which is the most significant, and that is where 90% of the first $1,174 of the AIM figure is credited at 90%. Then the second piece, which represents the earnings from $1,174 to $7,078, is credited at 32%. And the final piece, the earnings over $7,078, is credited at 15%. Again, we're talking about the actual three-part formula as applied to the AIM figure. So let's look at some real examples. This first example is a higher earner example of an AIM of $8,000, which basically says that adjusted for inflation, that worker over the course of a 35-year career earned $8,000 on average each month. Running that $8,000 AIM through the formula then produces the statistics of the first $1,174 yields a Social Security benefit piece of $1,056.60. The piece of AIM from 1175 to the 7,078 level, credited at 30%, produces $1,889.28. That's the second piece of PIA. And then anything over 7,078 is credited at 15%. That adds 138.30 to the primary insurance amount. When those three pieces are added together, it produces a PIA of $3,084.18, which is almost PIA. And I say almost because the next step is to round that down to $3,084 whole dollars. And once you have the final PIA, you determine the replacement rate by dividing that figure into the AIM figure. So dividing 3084 into 8,000 produces a replacement rate of 39%. That basically says that higher earning person can expect to replace with Social Security 39% of their average pre-retirement earnings. To show you the other end of the spectrum, here's a lower aim of $1,000. And you can see that the only piece that is credited in the formula is the first piece because it's under $1,174. So that's credited at 90%. And that produces a PIA portion of $900. And working down through the formula, you see that that's a replacement rate of 90%. Again, the $900 divided into 1,000 gives you the replacement rate of 90%. So to contrast the way replacement rates are affected by the standard calculation, and again, we're talking about the standard calculation formula for benefits. We're not into WEP yet. WEP takes that formula and adds a different perspective. But if you look at the high income person, that high income person has a replacement rate of 39%. A middle income person of a $4,000 aim has a benefit replacement rate of 49%. And then the low income person has a replacement rate of 90%. So that just gives you a quick feel for how the replacement rates vary. And what I'd like to do now is begin to get into some of the details of, first of all, WEP. We're going to talk about WEP first and then GPO. But remember that the examples that I just showed you were based on the standard formula for calculating benefits. Now we're going to get into how the WEP provision affects those standard benefit calculation processes. And I'd like to introduce Russ Glure at this point to take us into the details of WEP.
Thank you, Jerry. Just to kind of a lead in to go back, just a couple of reminders. The windfall elimination provisions refers specifically to how someone who has a non-covered pension, how their Social Security retirement benefit is affected. The GPO is completely different. It's a completely different formula and affects spouses and surviving spouses and ex-spouses who personally have a non-covered pension and then become entitled to a benefit as a spouse or a surviving spouse. So they're really windfall elimination provision, WEP, affects Social Security retirement benefits for those who have a non-covered pension. GPO affects those who have a non-covered pension and also have a survivor or a spousal benefit. So the other important point is the replacement rate that is definitely weighted. The progressive design of Social Security is definitely weighted to lower income workers. That is to say, lower income workers have more of their pre-retirement income replaced than higher income workers. So moving on, WEP was enacted in 1983 to equalize how benefits are paid to all workers. It lowers the Social Security income replacement rate for those with an extra non-covered pension. And the reason it does that is because Congress decided that those with a non-covered pension enjoyed an unfair advantage over those who do not have a non-covered pension. It affects federal retirees, as Jerry said before, under the old federal retirement plan called CSRS, Civil Service Retirement System. Newer employees of the federal government are not affected by WEP. It's only the older retirees that are. And retirees from state agencies, I would say most of the interactions that we have are people who work for a state agency which does not withhold Social Security FICA tax from their earnings. That includes 26 U.S. states, to which to some degree exempt employees from paying into Social Security. As Jerry mentioned before, people who come to the United States and live here and collect Social Security and also have a pension from another country, they are also affected by WEP. So why does WEP adjust the benefits? So the premise behind it is the standard Social Security benefit formula favors low-income workers, and those with a non-covered pension appear artificially to be a low-income worker. Therefore, they enjoy a higher replacement rate without WEP. WEP's intended to equalize how benefits are paid to everyone. Now here's a kind of a busy chart which talks to the why of the windfall elimination provision. The first thing I'd like you to focus on is the chart, the white chart on the left-hand side of the screen there, which is basically looking at how someone who only works in Social Security covered employment, that 100% of their earnings, well, it's actually not 100%, but all of the earnings that they have contribute to Social Security. There is something called a payroll tax cap, as only earnings up to a certain amount every year are taxed for the payroll tax. Compare that to somebody who has two careers, one of which is a career which they did not contribute to Social Security, working for a government agency, and the other of which they did work in employment that contributed to Social Security. So you can see that the level of contribution is decidedly different. Going back to the right under that white chart, you see the emphasis on 90% of the first aim bend point. That's the point that Jerry was just talking about a moment ago. Without WEP, someone who has a non-covered pension would appear to be a low income person, and therefore entitled to 90% of the first part of AIM. That is not the way that WEP worked. WEP, in 1983, Congress decided that provided those with a non-covered pension with what they called a windfall, which basically said that it's not right that those with a non-covered pension appear as low-income workers and are not, and get the same replacement rate as those who have spent their entire life contributing to Social Security. So WEP was enacted to correct what was perceived as a windfall enjoyed by those with a pension earned from work not covered by Social Security. And here's an example of the impact of WEP. The formula on the left is the standard formula. So if you look at someone with an AIM, that is to say an average monthly lifetime earnings of $1,500, 90%, the standard formula is 90% of the first 1,174, and that contributes $1,057 to the PIA. The second part, the second calculation is 32% of the excess over 1174, which yields another $104, which is added with the first part calculation to yield a total PIA of $1,161. It does not work that way with WEP. WEP uses a different formula. Instead of 90%, for those who have 20 years or less of contributing to Social Security through substantial earnings, they only get 40% of the first $1,174. So that's a big difference. They only get the first 40% only contributes $470 to their PIA versus the 1057 that the regular formula contributes. Now you see in red there that the WEP reduction, there's something called a WEP guarantee that says the WEP reduction cannot be more than 50% of the non-covered pension. The asterisk is really saying that if someone has more than 20 years, then that percentage, that instead of 40%, will be higher. 21 years would be 45%, 22 years would be 50%, and so on. It would keep growing until at 30 years, WEP no longer applies because it is equal to the standard formula. So you can see the bottom line there is that with a WEP formula for someone with 20 or fewer years contributing to Social Security, contributing to Social Security, the bottom line is that their PIA is $574 compared to the standard formula, which yields $1,161. And that kind of leads us into what I refer to as the WEP surprise. Most of the people that we talk to are either surprised that WEP even exists, or are surprised at the magnitude of impact it has had on their earned Social Security benefits. And that comes from, Jerry mentioned before, state and local governments are required to inform uh, employees that not contributing to Social Security will have an effect on any future Social Security benefits that they might become entitled to. The discipline for that, though, it varies. The 26 states that have the ability to do this, they are inconsistent in how much and how well they inform their employees of it. The other problem is the statement of estimated benefits that you get from the Social Security Administration does not show the effect that WEP has on your earned Social Security benefits. And it can't, because Social Security doesn't even know about your non-covered pension until you apply for benefits. So the statement that you get from Social Security it includes a vague warning that if you have a non-covered pension, your Social Security benefits are going to be affected, but it cannot determine how much. Therefore, it ends up being a surprise to people when they actually apply and say, "Whoa, I didn't expect it to be this drastic of a cut." So the end result is that many approach Social Security eligibility with a dimmer or non-existent understanding of WEP's impact because of their non-covered pension. As I said before, many know that WEP will have some effect, but they're just not prepared for the amount. And the result is they go into retirement kind of in disarray and getting much less than they anticipated getting. Social Security is, by definition, usually a big part of everyone's retirement benefit.
Yeah, and
So,
I would just interject here, Russ, that part of the frustration comes from the fact that once it's become clearer the impact of WEP, it's at a point in their financial planning for retirement where it's just too late to do anything about it.
yeah, that's
All of a sudden, the benefit that they had counted on is not what it was projected to be.
Yeah, good point. And I mean, most people obviously don't start even thinking about Social Security until they're 60 or 62 years old. You can't
Yeah.
claim before you're 62, but you're 62 years old and you're working against a 35-year lifetime earnings history. It's kind of late in the game to try and go back and do anything to correct it. But you can see in this instance here, the big surprise is someone who thought they were going to get $1,161 is instead going to get that previous number, 400 and some dollars that I showed you before, an impact of $587. That's a lot of money for a retiree. And as Jerry said, it's kind of late in the game to go back and offset that. So how do you mitigate WEP's impact? Well, it can be done, as I mentioned before. For each year over 20, you get another 5% of that first spend point. So 20 years, you get 40%, 24 years, you get 60%, 28 years, you get 80%, 30 years, you get 90%, which is the same as the standard formula. So WEP does not apply to anyone who has 30 years contributing to Social Security from substantial earnings. And the WEP guarantee that I mentioned before is that WEP reduction cannot be more than 50% of the non-covered pension. And where this helps is if someone has basically a low non-covered pension and has worked a lot of years in Social Security or contributing to Social Security, the maximum amount that their reduction of their Social Security benefit is going to be is 50% of their non-covered pension. And surprisingly, many people think that they're not going to get any Social Security benefit because of WEP. Fact of the matter is, WEP cannot eliminate a Social Security benefit. It can only reduce it. So the arguments pro and con, well, WEP opponents say WEP's unfair because it reduces benefits that were rightfully earned, and that WEP penalizes first responders in many, the 26 states I mentioned before, which include law enforcement, includes those who we view as our heroes. It includes law enforcement officers, firefighters, and EMTs. And in 13 states, it includes educators, teachers. So, we consider all of those people kind of our are heroes, if I can use that term, the ones that are affected by WEP that we respect so much. The WEP proponents say, however, that WEP equalizes how benefits are paid to everyone. WEP avoids overpaying those with a pension earned outside of the Social Security. Now, the government pension offset, I just want to go back for a moment and mention that the premise that WEP is based upon, before I get to the GPO, the premise that WEP is based upon is that the states who exempt employees are obligated to provide a pension which more than offsets the effect of WEP, the effect that WEP will have on their Social Security benefits. The fact of the matter is that the average non-covered pension is about $2,600, whereas the average Social Security benefit, I think in 2024, is about $1,900. So you can see that there's a distinct difference between the size of the pension, of a non-covered pension and Social Security benefits. Now, the GPO, as I mentioned before, is a completely different animal. The GPO has nothing to do with AIM. It has nothing to do with PIA. It has nothing to do with the number of years that you contributed to Social Security. Strictly affects only spouses and survivors, and by spouses and survivors, that could include ex-spouses if they were married long enough, and only those who receive a non-covered pension without contributing to Social Security. The GPO reduces the Social Security benefit for a spouse or a surviving spouse by 2/3 of the value of the non-covered pension. That's the key right there. 2/3 of the value of the non-covered pension has nothing to do with AIM or PIA or any of that. Foreign pensions do not cause the GPO to apply. So there's this thing called dual entitlement rule, and basically what that says in the normal circumstance for Social Security, a worker who is entitled to two benefits, in other words, they're duly entitled, they will get both benefits, but one will offset the other. In other words, if they're entitled to a Social Security retirement benefit and they become entitled to a survivor benefit, which is higher, their Social Security retirement benefit is paid first and then supplemented by an auxiliary amount to bring their payment up to what they're entitled to as a surviving spouse. So the GPO's premise is that a non-covered pension is equivalent to the normal Social Security retirement benefit. And the GPO uses 67%, 2/3 of a non-covered pension as the person's retired worker benefit. When a normal surviving spouse benefit is calculated, they use 100% of the person's Social Security retirement benefit to offset the survivor benefit. Now, here's a couple of examples. I'm going to compare normal calculation to GPO. When the survivor benefit is less than the retirement benefit, the person gets their survivor benefit amount, and it's offset by 100% of their retirement benefit. In this case, there's no auxiliary amount, there's no extra amount, so they get only their own Social Security retirement benefit. Compare that to when the survivor benefit is more than the retirement benefit, they get their survivor benefit amount, which is $2,000, minus their own Social Security retirement benefit, so they get $1,000 off of the $2,000, leaving an auxiliary amount of $1,000, but they get back their 100% retirement, so they get $2,000. In other words, they get the higher of the two. Now, contrast that with how it works for GPO. And you need to remember what I said before. The Social Security considers the non-covered pension as something equivalent to a Social Security retirement benefit. In that case, if the survivor benefit is 2,000 and 2/3 of the non-covered pension is 2,000, there's no auxiliary amount, so therefore the person gets 100% of their non-covered pension, and they get no additional amount as a survivor. Now, when the survivor benefit is more than the retirement benefit, in the case of GPO, if it's more than the non-covered pension, the survivor benefit amount is 2,000. 2/3 of the non-covered pension instead of 100% of the non-covered pension as above leaves means a reduction of $667 instead of $1,000, which means that the auxiliary amount is 1,333 added to their non-covered pension yields a total benefit amount of 2,333. So you can see that in that instance, the GPO yields a better result than those who do not have a non-covered pension. So GPO also affects spouse benefits. Previous examples were survivor benefits. GPO also affects spousal benefits. That is to say, when both partners are living and there's a low earning spouse or a spouse with either low Social Security benefit or no Social Security benefit, the GPO will apply to the one with the lower amount. But it only applies when that spouse who has the lower amount is also receiving a non-covered pension. The spousal assignment is based upon pre-WEP benefit amount. In other words, the pre-WEP full retirement age amount must be less than half of the partner's full retirement age amount. GPO reduces the spousal benefit by 2/3 of the non-covered pension, the government pension, and it typically eliminates the spouse benefit for a living spouse. And of course, it depends on the amounts. If you have a high non-covered pension, 2/3 of that is usually going to offset the spousal benefit for a living spouse. So can the GPO be avoided? Yeah, it can. Foreign pensions don't cause GPO to apply. GPO doesn't apply if the non-covered pension is forfeited before taking it. In other words, somebody can look at what the impact of the GPO would be, and if they have a small non-covered pension, they can opt to forfeit their non-covered pension, but they have to do that before they take it. And they can withdraw all personal contributions and with interest prior to retiring. But that's one way. If you forfeit the non-covered pension before you start receiving it, you can avoid the GPO. And then there's a special rule that exempts someone from the GPO if they're contributing to both Social Security and the same non-covered pension for 60 months just prior to retiring. The point being, in the white box on the bottom, the GPO is possible. Avoiding the GPO is possible, but it's very difficult. So the arguments pro and con. Those in favor say GPO equalizes how benefits are paid to all spouses and survivors, but actually gives some advantage over regular spouse and survivor benefits. And it avoids overpaying those with a non-covered pension earned outside of Social Security. Those opposed to the GPO say GPO punishes needy widows and widowers and lower earning spouses, and it's unfair because it targets the most vulnerable among us, namely widows and spouses who have a very little income after their spouse dies. Spouse and surviving spouse benefits should get all Social Security available to them, as said by those who oppose GPO.
Okay, so just wrapping up quickly, our objective with this seminar was basically to provide some objectivity on the issue. There are a lot of discussions that go on about WEP and GPO without fully understanding the way that they work and why they work that way. So that's what we tried to do. We tried to explain why the provisions were enacted and basically how they actually will work to adjust benefits. And we think there are some factors that contribute to the emotional side of the argument. And as I mentioned earlier, that being that the financial impact of the effects on retirement plans is often, first of all, not anticipated. And second of all, when it's realized, It's at a point where it's just too late to really do anything about it. The information that was provided in advance that basically alerted people to how WEP and GPO will affect them might have been delivered, 35 years earlier. And so it could have been either not understood completely in the beginning or forgotten, frankly. So we just wanted to give this seminar to give some additional perspective on these two provisions and the way that they work and why they work that way. So that was our objective. And so the question becomes, are WEP and GPU fair? And our position is you decide. We're just trying to provide some background here on how they work and why they work that way. So thank you for joining us. We appreciate your time. And this is part of an ongoing seminar series that we operate at the foundation. And you can find out more about those events on the foundation website, amacfoundation.org, on the events page. And I would also, again, encourage you to stay tuned to our Social Security Report.org website, where we post information daily about Social Security, things that are happening in Social Security, as well as Medicare report and healthcare. So with that, I'll say thank you and stay tuned for more seminars of this type.